So we have the exam next Tuesday. I'm considering making the first question and that you submit on Blackboard, open the notes, we'll have to just see. If I do that, I want a better answer than in class, but it's a complex issue. So let's just look at this question, make sure you're ready for it. We haven't covered everything yet. We're going to cover the straddle tonight. So your class notes starting on page 69 of the class notes and explaining what ALM is and talking about how you have to be balanced whether rates rise or fall, and then talk about the special issue of disintermediation rates risk when rates rise, guaranteed minimum rates when interest rates fall. That's what you're explaining. So it's this part of the notes. It's not an easy answer, but it's an extremely important question. I talk about this a lot when I talk about pension plans. If some of you take my risk management class, we talk about how pension plans are so horribly managed. They're like 60–70% in stocks. They're terribly underfunded until this last year. This last year, they did well mainly because interest rates rose, and that's really good. And I remember managing UTSA's pension plan like everybody else did. And I talked to our life actuary, and he just said, "You guys are idiots. You don't know what you're doing." The risk that a pension plan manages and that a life insurance manages is very, very similar. Life insurance companies never invest in stocks. Pension plans are 70% in stocks. So what's the difference? And his argument was, you guys are idiots. You know what you're doing. So life insurance companies have been managing this very difficult risk extremely well the last 40, 50 years. There have been some insolvencies, but very few. Pension plans have been doing a horrible job. I remember in 2008, of the the largest 1,000 pension plans, every single one of them went from a surplus to a deficit in that 1 year, except for UTSA. We were the only ones that didn't, because I listened to the life actuary. And now all these companies are shutting down pension plans. Why? Because they didn't manage it the way life insurance companies do. If they had managed it like life insurance companies, we'd have all these pension plans and people would be much more secure in their retirement. So it's not an easy risk. I do believe the life insurance industry does it better than anybody. And we saw with Silicon Valley Bank that banks don't do it all that well. That managing interest rate risk is a huge, huge issue. And life insurance, they do it well because they have to. Because remember, they don't have much net worth relative to their assets. So small mistakes have huge, huge implications. And so what does this have to do with a straddle? So I put the file out there under a miscellaneous, and I tried to make this look as much like exactly what our life actuary showed our CFO, our CEO. So UTSA had this committee called the Corporate Asset Liability Management Committee. It was our risk committee, which I really liked because our risk committee was called the CALM. So that's pretty good, right? You have a risk committee and they call it CALM, but Corporate Asset Liability Management Committee. We could maybe get 10 people to show up, and then we got a new CEO, Bob Davis, and he says, "I'm going to come to all the meetings." And then suddenly 50 people were showing up at our meetings. And we were going through the property casualty company, the bank, the life insurance company. And one of the things we did is run your business with interest rates rising, with interest rates falling. And so this is what the life insurance companies show. With interest rate, these are our assets. Interest rates fall, the assets rise. When interest rates rise, assets fall. That's what you expect, right? It's a bunch of bonds. Bonds rise in price when rates fall. They fall in price when rates rise. And here's the liabilities. You'll notice the liabilities are far, y'all remember the word for why it's curved like that? Riley and Elizabeth, you're in my investment class, and Diana, what's the word for that curvature? Convexity. So what do you say here? That liabilities are far more positively convex than the assets. This doesn't look horrible, but when you graph the difference in the two, that's the chart they showed him. And what happens is as interest rates rise, this whole thing starts shifting over. It starts going like that. So when rates fall, that's what he was saying. Rates fall a bunch. You have these guaranteed minimums of 4% you have to pay. And you're not making but 4% on your assets. So you're losing money. When rates rise, people are taking their money out and going to banks, and you're having to sell these bonds for a large loss. So that looks like a short straddle. So what is a short straddle? So we just did this, right? Riley and Elizabeth and Diana, we just did this in my other class. A long straddle is you buy a put, you buy a call. So that's pretty expensive. If the stock price doesn't move much, so if you buy a put, you're hoping the stock price falls a bunch. If you buy a call, you're hoping it goes up a bunch. If you buy both, you're hoping it moves a bunch, up or down. But if it doesn't move, you're out a lot of money. But if it moves a lot, you start making a lot of money. That's a long straddle. That's when you own a put, own a call. But if you sell this, that's what it looks like. And does that look familiar? Isn't that what I just showed you? The life insurance company. It's that negative convex. So what I like to say is life annuities are like a short straddle on interest rates. What is the key here? So what do long straddles like? You remember that from the class? What are they hoping for? They're hoping for volatility. So they hate volatility. And that doesn't look correct. Does volatility have an O in it? Volatility. Oh, no, it's volatility. They hate volatility. Now, the CEO, his question was, why would I ever do this? And they say the reason you do this is actually very profitable. This section where they're positive is extremely profitable. Interest rates have to move a lot before they start losing money. What's happened the last few years? Interest rates have moved a lot. They fell a bunch, and now they shot back up a bunch. We haven't heard any life insurance companies going insolvent, though, have we? We heard banks going insolvent. So somehow they're managing this risk pretty well. One thing I've noticed is bank CD rates. My church buys CDs, and it's real frustrating to me that Frost Bank has a 3-month CD at 4.4%, and I can buy 3-month treasuries at 5.5%. It's like, I can buy this less risky asset that's paying 1% better. So I'm now trying to get a brokerage account opened up so I can buy treasuries, because the CD rates are terrible. So I think part of the issue is banks just are not that competitive yet. They're not really getting deposits. So I doubt life insurance companies are seeing that much money fly over, because if your annuity is paying 3.5%, 4%, and the bank's paying 4.5%, it's not worth the hassle. Because remember, you have the surrender fees and those kind of things. But if rates were to keep rising up to 6, 7, 8%, you're going to start seeing this thing start going over here. And you're probably going to see a few life insurance companies go under, but still, they're much better at managing this risk than banks are. Plus, this is only their annuity business. So their life insurance business somewhat protects them from some of this. It's not nearly as bad. Because if you disintermediate on life insurance, you're losing your life insurance. There's a lot more going on. But annuities tend to be hotter money that are chasing rates. And so when rates rise, it's an issue. So you need to be able to explain, and this is one of the reasons I'm thinking about making this open book, so you can copy and paste these charts into your answer and then just explain them, then versus trying to draw them. It is comical watching some students draw these graphs on the exams, because some of y'all are worse artists than I am, which is pretty sad. But it's a tough thing to draw. I use pretend numbers here. What I did is I used duration and convexity, and I just gave a different convexity to the liabilities and to the assets. So you don't need the actual numbers. It's just a shape. So, this is the value, and then this is the net worth. So this could be a $500 million company or 500 billion. There's not really companies that large. So what are we going through right now? We had periods of very low rates, and now we've shot the periods of high rates. So essentially the industry is just moving this direction. It was fun to watch because we had quarterly meetings. It was fun to watch this kind of snake back and forth depending on what rates did. It was pretty amazing. So questions on that? Do you understand this concept of a short short straddle. So you're betting on stability when you short a straddle. You're betting on volatility when you buy a straddle. And we talked in my investment class on stocks, you tend to buy straddles right before a firm announces earnings, hoping there's some major news and the stock really moves up or down. You don't really care. You just want it to move. Here, life insurance companies, boy, they suffer badly when the Fed starts doing some strange things. So if you look at the question, fully define and discuss what is meant by asset liability management in a life insurance company. So you have to talk about rates rising and rates falling. Rates rising, what was the issue there? Anybody remember? I'll give you the first letter. I think I heard it. Someone say it louder. Disintermediation. And rates falling, what's the issue there? Something banks don't have. Starts with a G. Guaranteed minimum rates by law, right? This isn't, I mean, they have their own, they can set their rates higher, but laws are stated that, hey, if you offer this product, the lowest rate you can pay is 3%. And it's been as high as 4.5% in the law because rates got so high. So what produces that short straddle? And it's the fact that they get beat up pretty badly whenever rates do something crazy. As long as rates stay stable, it's an extremely profitable product. Remember at USAA, now this is some years ago, the life insurance products were making 10, 11% returns. The annuities are making 18% returns. They're much, much more profitable. But why are they much more profitable? Because they're really dangerous products. I doubt there's many life insurance companies that all they sell are annuities. So they have the life book to kind of help offset some of this. So do we need to talk any more about question one? Do y'all prefer it to be open book or closed book? Open? Is that like a stupid question for me to ask or not? So if we make it open, I usually make it due when the exam starts. I might give y'all like till noon the next day, just because I'm just now telling you that. So, but I'll put it out there. So that all makes sense. All right. I do want a better answer if it's open books. So, and you can't just copy and paste the notes. So make sure you don't do that because you don't get any points if I'm reading my own words. I already know what I think about this. So I need to know what you think about it. So put it into your own words. So the best thing to do is read the notes, listen to the lectures, and then type it completely off the top of your head without looking. They're already there. You're talking about these charts? Yes. Yeah, if you go out on campus, I should be there. I keep forgetting to publish, but I think they're there. Yeah. So under miscellaneous, yeah, the straddle example. Now I've had students ask me if the mortality table will be provided on the exam. Yes, you don't need to memorize the mortality table. Some of y'all freak out way too much. All right. So no more questions on that question. Pretty important question if you're interviewing with a life insurance company that has an annuity, especially if you're an actuary. The actuarial exams part, I don't know which ones, but there's definitely interest rate theory on the actuarial exams, like an extremely important part. And you can see why this can destroy the entire company pretty easily. All right. So last class we did the first endowment, right? And I think I worked through the numbers somewhere. I guess I must have done it in Excel or someplace by hand. What I want to do is this complex problem. Anybody try it? I think Frank Harris is the quarterback, right? UTSA. I think that's where I got that name. Is he related to Franco Harris? It's probably named after him. So if we look at this, remember the formula is the present value of outflows divided by the present value of payers, premium payers. So that's going to be the formula no matter what you're doing. So what are the outflows here? So the outflows are pays a lump sum of 10 million at age 95. L95 divided by 1.04. So here you've got it's paid 10 million at the beginning of age 95. So what is my L here? We're starting it's 25 and L95. So my N is what? 70. Beginning of the year, you just subtract. 95 minus 25 is 70. If you just did that, you'd probably get 5%, 10% credit. You get something. So there's the first one. The second one is it's going to pay 15 million at those live at L96. So again, 1.04 in here, it's just going to be 71, 96 minus 25 plus probably too many parentheses here. And the last one, so you have to be careful. I messed this up on one of the problems. A death benefit of 20 million at the end of age 99. Now, in this case, L99 and D99 are the same number because everybody dies. But we're doing the end of the year because this is a death benefit. So I could have paid it to L99s at the beginning of the year. Instead, I'm paying it to the same L99, but at the end of the year because they're all going to die. So now what is my N? 99 minus 25 is 74. So what's my N going to be? Yell it out. You probably know it. 75, right? So if it's at the end of the year, you add 1. If it's at the beginning of the year, you subtract. You don't need fingers. You just, just basic subtraction. So there's the numerator. That's pretty straightforward. The payers is pretty straightforward too. They're going to pay a premium at the beginning of years, age 25, 26, and 27. You can't get much easier than that. So it's L25 plus L26 divided by 1.04 plus L27 divided by 1.04 second. So premium payers is pretty straightforward. It's the same thing you subtract, right? 25 minus 25, that's 0. So you raise it to the 0 power, which is dividing by 1. 26 minus 25, that's just going to be raised to the first. 27 raised to the second. So premiums always pay at the beginning of the year. And so there you always just subtract. So let's try that in Excel. L25, L26, 27, L95, L96, 99. D99. See, D and L are exactly the same here. I set up the formula. These people get paid 10 million. These people get paid 15, and then 20 million. Did anybody try it? Get a number? All right, so L95 times that divided by 1.04 to the 70th plus 96 times that divided by 1.04 71st plus that divided by 4 to the 75th. That divided by 100,000 plus 99,000 divided by 1.04 plus that divided by 1.4 second. So what do you think it's going to be? They're going to pay out $45 million. So if someone dies at 95 years old, they're going to get $45 million. How much would you have to pay for $45 million? You have to do it 3 payments. Let's see if I did it right. $7,000. Anybody get that number? I wish we had Excel for the exam because I'd also make you do this part of it, is actually prove it that it works. So age 25, all the way down to 99. Beginning balance is 0. You got a premium, you got a payment, and you have an ending balance. So at age 25, you're going to have 100,000 people pay you 7,954. No payments. Your ending balance here is going to be beginning balance plus your premium, but in this case, you're paid at the beginning of the year, so you make your 4%. Then the next year, you have your beginning balance. Then you have your premium, which is going to be L26 times $7,000. No payments, and your ending balance is going to be your beginning balance plus your premium. Both of those make 4% because your premium is paid at the beginning of the year. The next year, you're up over $1 billion. Your next premium is going to be L26 times the $7,000. No payments, ending balance. That we can just copy on down. Until when? It's at 95. So at 95, we're going to pay L95's $10 million. And so in this case, you're paying them at the beginning of the year, so you have to multiply the 4% here. So here we're going to put that $15 billion, we're going to put that before we do the 104. If there's a death benefit, we would multiply the 4% on the first two, but then we'd subtract the death benefit at the end without multiplying. But here, since it's a living benefit, we're going to do that. The next year, we pay another $15 billion. And then the very, very last year, age 99, if I did this right, it'd be embarrassing maybe if I didn't, but we'll see. It looks pretty good though, doesn't it? We don't need the 4% on this. Y'all see, you understand that? See that? Because it's at the end of the year, so we just subtract it. And it worked. Somehow magically it worked, even with all of y'all looking at me. So I love these type of tables because Excel with the open architecture, you really have to understand what you're doing to build it in there off the top of your head. I think it's a good exercise to be able to do. But now, would you spend $7,000 for 3 years so that you can get $45 million? You make it to 99. That's a lot for a 25-year-old. Instead of 45 million, maybe it's 4.5 million, then you pay $700 for 3 years. Would you do that? Who knows? But it's not a lot of money. You pay that for 3 years and you get 45 million. You pay $21,000 and you get $45 million. It's a pretty good return that you can't really get anywhere else in the world. I can't remember what the answer was. 759.73. Did anyone get that yet? A couple of you? All right. So is there any reason to leave a question like that blank? You can see big chunks of it is pretty simple. It's not that difficult. If you get the wrong answer, no big deal, because if it's a math error, these are big numbers. It's really easy to type something wrong, leave off a zero or something. So you have no way of checking it. I don't want you to stay up here till 2 a.m. making sure it's right. So, if you have it set up, you should probably write it like this and then do the math so I can see that you understand the equation. You'd probably get almost full credit if you write this and you just have a math error. You might get 100% just because the math error is off.
Is that the 20 million times D99? Is that supposed to be multiplied by 1.04?
Oh, divided. Sorry. Yeah. Good catch. All right. I'll see if y'all need another mature endowment. Maybe we'll do one on Thursday, a little practice. But I do think you're probably not prepared for the joint life. So let's do some joint life. You might do both of these to get some practice. It's a little different because of the way I'm not dividing by the L to get the premium because that's implied in the probabilities. So it looks a little different. So we have an L90, we have an L92, and the payout occurs when one or both dies, or that equals 1 minus what? Both live. Okay. That's 1 minus L91 divided by L90 times L93 divided by L92. L91 divided by L90, that's the probability that the 90-year-old makes it one more year. Yeah, remember that? We did that some time ago. L93 over L92 is the probability the 92-year-old makes it one more year. So if you multiply those two together, that's the probability they both live. It's 1 minus, that's the probability one dies, the other dies, or they both die. Let's get this number. L90. 91, 92, 93. So we're going to have 1 minus 91 divided by 92 times 93. 91 divided by 90 and 93 divided by 92. It's probably going to be a fairly high because they're pretty old people. So it's probably going to be a pretty decent number. So it's pretty high. There's a 42% chance one or both dies. So there's a 58% chance they both live, but there's a good 42% chance one or both die. So 41.89. Now, if we're doing 25-year-olds, that would be a really, really small number. Probably be less than 1%. All right, so what's the premium? The premium is going to be the payout. The payout here is $100,000 times 0.4189 divided by 1.04. So you're saying, well, where did the livers go to pay the premium? They're essentially in this number right here. When we're dividing, so when you're coming up with this, that's where we divided by the L's. So don't get confused. All the other problems you had L's in the denominator. This one you don't because we took care of that when we did the probability. All right, so don't freak out. Say, wow, what did I do with the L's? So you've taken care of that here. So that's your premium. Plus 100,000 times 0.4189 divided by 1.04. So the premium is 42,278.85. You're essentially, it's going to be real close to your probability. The only difference is the time value money, right? So you're expecting to pay out $41,890. That's your probability, but you discount that for 1 year, so you know the present value is only 40,000. So the question is, what would this have been if they had instead bought 2 term policies? So the 2 terms are this. You can go back to what you did before. D90, if you want to, times 100,000 divided by 1.04 plus D92 times, divided by 1.04, and that divided by L90 plus D92 times 100,000 divided by 1.04 divided by L92. That goes back to the original formulas we were doing. Oops, I don't know why I did that, sorry. So D90 92 so D90 times 100,000 by 1.04 divided by L90 plus D92 times 100,000 divided by 1.04 divided by L92. So what is the difference? Difference is $5,000. You get that far, you're in pretty good shape. There's one last thing, probably about 20% of students get, but can you back into this difference? So what is the difference going to be? What's the only difference in these two policies? There's only one scenario. A few weeks since we've done this. So the joint pays if one dies, 100,000. The joint pays 100,000 if the second one dies. What does the joint pay if they both die? $100,000. The term pays 100,000 if this one dies, pays 100,000 if this one dies. What does it pay if they both die? 200,000. All right. So one's the only difference if they both die. All right. So what's the probability they both die? And that's going to be D90 divided by L90 times D92 divided by L92. That's the probability they both die. If I did it correctly, we'll see. That looks about right. So the probability they both die, so you've got probability both die times 100,000 divided by 1.04. Let's see if it works. So probably both die times 100 divided by 1.04. Nope, I'm off. I don't know why I'm off. Let's see what I did wrong here. They'll see my error. Could be that I'm not multiplying. There we go. It was rounding. So go back through it again. So the first thing you do if you want to do it in steps, calculate the chance that one or both die. That's 1 minus L91 over L90 times L93 over 92 or whatever I give you. All right. So that's the probability one or both die. 1 minus the probability they both live. Then you calculate the joint. So second step is you calculate the premium. So the premium is going to be the face times probability one or both die divided by 1 plus the rate. So that's your premium. If you got your premium, that's a big part of the problem, like 70–80% of the problem there. The second thing is calculate the premium for two term policies. So we got the L90, we got the L92. There's the premium for both policies. That's step 3. Step 4, get the difference. So step 1, probability one both die. Step 2, get the premium for the joint. Step 3, premium to term. Step 4, difference. And then step 5, recon difference. And that's going to be probability that both die times the face divided by 1 plus the rate. I got it exactly to the penny because I didn't have rounding issues. When you saw when I had rounding issues, it was off by a few dollars. And then the last thing is just a really quick statement. We talked about this in class, but it has been a couple of weeks. So the key here is probability both die. For young, this is extremely low. So best to justify 2 term. I don't know if y'all remember that, but for young people in their 20s and 30s, don't buy joint. You can buy 2 term policies and they're only going to be a few pennies more expensive. You're really not saving anything. For older, say maybe over 70, can be more significant savings from joint as probability both die is much higher. However, which they buy depends on why buying the insurance. I think this is in the class notes, but this it's pretty obvious if they need, if the second surviving spouse, it doesn't mean a term is the same, but if both of them die and create some special tax issue, they want to leave more to their heirs or whatever in that issue, then maybe the 2 term makes some sense. If the main reason they're buying this, which is true for a lot of people, is these 2 spouses, maybe they have retirement or they have Social Security, and when one dies, the other loses that income, the person who died. Usually what you're doing with the joint life is you want to replace that income. If that's the case, they don't need the 2 term, because if they both die, that's not an issue. They lose both incomes, they're done. But if there's some special tax reason or some special purpose why both of them dying together, they need twice as much money, then yeah, spend the extra money. But the joint probably for most people 70 or later probably makes sense because of the reason they're buying. They're probably buying it just in case one dies, the other has some replacement for the income, the Social Security or pension that's lost. Now, what age do you start saying joint makes sense? I don't know. You'd have to do the math. Definitely after 50. So 30, 40, 50-year-olds or 40-year-olds, the probability of both dying is just so low. Doesn't make a lot of sense. Now, what we didn't do here, because we just don't have time, is like a 10-year joint life or something along those lines. Then the math gets a little more tricky. But we're not going to do that. We're only doing 1-year terms. So, all right. Does that make sense? This essay is a short essay. This one you have to do in the exam. So there's really 3 types of essays. The one we just talked about with ALM, that's the long one. This is the second one. You have to write a little bit about the joint life. And then the other one was on the ALM pricing problem. If they can't hit their ROE, what are your options? So that was the third one. So most of it's a math exam, but there are 3 things you have to write about, and this is the one you have to do. Questions on any of these steps? I don't know if it helps having steps. All right, so let's try one more, just because I know this one's trickier. I'll save this Excel out there again, although you know it's kind of messy there at the bottom, but at least you can see it. All right, so let's try this couple here. We got L85 and L90. And we'll need D85 and D90. So probability 1 or both dies. Anybody want to try it? Looking at your notes. What's the first 2 digits? Somebody knows it and you're too scared to say. All the actuaries know it, I know. What's the first thing I'm going to type? 1, and then minus, and then what? Which L comes first? 86 divided by what? 85. And then times minus what? Times L90, yes. So that's it. And then your premium is going to be probability 1 or both dies times the face divided by 1 plus the rate. So it's actually a fairly simple formula. I'm going to cheat on these because I know what it is. So there's my D's. 2758, you don't believe me, you can go and look at it. 2758, because it's just the difference. So step 1, probability 1 or both dies. It's going to be 1 minus L86 divided by L85 times 1 times L91 divided by L90. So not quite as high as before because they're a little bit younger, but it's still a pretty significant number. See if I get the same steps twice in a row. So your premium, the probability 1 both dies times face divided by 1.04. I think it was 4%. Yep, 4%. What was the face? This one's only 50,000. Okay. So plus 50,000 times that divided by 1.4. That seems too low, so I don't know what it's 50. Yeah, I'm thinking 100,000 still. So 34% of 50,000, that seems about right. All right. Step 3, I can't remember. What did I say step 3 was? Oh, two term policies. So it's going to be D85 times the face divided by 1.054 divided by L85 plus D 90 times the face divided by 1.04 divided by L90. The nice thing about this, if I do it wrong, I'll know because we'll when we do the reconciliation, we'll be off. Let's see if this looks reasonable. That looks kind of reasonable. And step 4, the difference, am I sticking with my steps? Yep. And then step 5, reconcile, I think. So here we want probability that both die. That's going to be E85 divided by L85 times E90 divided by L90. So E85 divided by L times E90 divided by L. So it's a low probability, but they are in their 80s and 90s, and for both of them to die, you know, it's kind of what we expect. So difference is going to be the face times probability both die divided by 1.04. So 50,000 times that divided by 1.04. Does that look close? It's pretty close, doesn't it? And then you have your explanation. They're old enough, it can make some sense. So put in your answer, it doesn't make sense for younger people, especially people under 50. Why you need to specifically say, because the probability of them both dying is just so low, and that's where the savings is on the joint life. You're just not saving much. You might as well buy the 2-term. For older people, it can make sense. The savings can be significant. But for most people, it probably, you know, the joint is probably good because they're probably buying it. They probably don't need the extra $50,000 if they both die together.
Go back to the probability that one of both dies. Equation. So,
This one here.
no, step 1 actually. On the equation.
So 1 minus L86 over L85 divided by L91 over L90. Are you not getting 34%? You're kind of getting used to these numbers. So, you know, in an exam, if I give you 80 to 90-year-old people and you get probability both one or both dies, it's like 4% or 80%, you probably did something wrong. It's probably gonna be too high. I'm not going to give you a 96-year-old and a 97-year-old. That'd be a little too ridiculous. So, questions on that? Are y'all okay? Everybody's good? None of these questions by themselves is difficult. The problem is you get them all at once and you got to study and learn them all. So, you know, it's a matter of figuring out. If you understand the concept, a lot of this will come back, but you do need to practice them. So you got some good practice problems here to experiment with. So I'll put this Excel out there, but just realize these bottom problems, you have to know how to tie them back to the example questions. All right, then the ALM problem, we worked one of them. So Thursday night, I did want to cover a little bit on regulation just to make sure, you know, there's some really hot topics. So in fact, maybe I can just real quickly. Because I thought Thursday night we might work some more problems. So think about it Thursday night. which problem you're most worried about that we can practice. We'll look through the exam review. But the material we haven't covered yet, life insurance accounting is pretty important if you're going to work for the life insurance company. There's nothing you've had in your undergraduate that's going to help you with this. They don't teach bank accounting or insurance accounting much at all in the graduate. If they do anything, they do a little bit of banking, but they don't do much life insurance or P&C. The insurance accounting is its own thing. So you can, with Allstate and MetLife, you can get their statutory financial statements online. If I were interviewing with these companies, I would pull those statements in. So the key to understand when you interview with life insurance companies is there's two books of accounting. There's the statutory, which the states require, and there's the GAAP, which you're used to. The statutory is what the regulators require from a standpoint of making sure firms don't go bankrupt. So it's very, very conservative. GAAP accounting is what the SEC requires for all publicly traded companies, and it's really focused on the investor, for them forecasting the future of this firm. It tends to be a little bit more realistic, although it does have some conservatism. The statutory tends to understate good things and overstate bad things. It must be filed with the state every quarter. The SEC, you got to be filed every quarter with your investors and online. The thing I don't like about GAAP is when you get the annual report for MetLife or Allstate, it's the entire company. It's the property and casualty, it's the life insurance, it's everything else. It's all mixed together, and there's really no good way to break those out. So if you're interviewing for a life actuary job at MetLife, going to their GAAP financials that the SEC publishes is not going to help you much because it's going to be everything clumped together. But if you go to their website, and you find the investors pages somewhere in here, corporate. Oh, investor relations, there it was. And then it disappeared. There it is. All right, investor relations. They'll have a section for GAAP, and they'll have a set. Y'all know the MetLife building in New York? You have seen that famous building. So last time I looked, it was really easy to find, but I'm not seeing it. Let's say I'll find it and show you an example of it. So we don't have time to go into it in detail, but if I were interviewing for a job, the annual report is what's going to really help me. It's going to tell me what lines of businesses they are. Do they sell annuity? Do they sell health insurance? Do they do term life? Do they do whole life? All that's going to be in there in magnificent detail. It's going to show you what investments they have. That's the other thing we didn't get to cover, but most of it's going to be bonds. But you can look and see. Remember we talked about high yield bonds versus investment grade? That's all in there. You can see what affiliates they have. Their entire structure is there. There it is, statutory filings. That's all in there. You want the annual filings. I guess I have to do 2022. So there's their annual statement. And it's going to be like 500 pages. So don't click on it and hit print because it's going to go on forever. And it's usually legal instead of normal 8.5 by 11. So yeah, oh, forget that. It's 2,000 pages. So you get a lot of detail. Now, 90% of this is worthless. But fortunately, the most valuable stuff's right up front. It's the annual statements, financials. It's income statement, the balance sheet, income statement, all of that's up front. A lot of really good stuff up front. this stuff is really good because it shows you there's their life insurance, their group life, their annuities, their group annuities. It shows you not only what businesses they have, but what the profit of each one of those is. It's really useful for information. So if you're interviewing with the life insurance company, go and see if they have their annual report. Now, if you're interviewing with USAA, you're out of luck. They don't publish these online because they don't have to. USAA, for some reason, only publishes GAAP, even though they're not required to, and they only give a very, very high summary. So now, if you could get the USA and still want annual reports, maybe while you're in there, take one off of someone's desk. It might not get you the job, but you could get a lot of really good insight. There is some great information further down. Oh, but my word, you'd have to know what you're looking for. So what I recommend, if you're interviewing with a firm like this, come talk to me and I'll tell you what pages you want to look. There's certain things you want to know about the company that you can get out of the annual report that you can't get out of the GAAP financials. But yeah, it's 2,000 pages. Why is it 2,000 pages? Because they have to list every single bond that they own. That can be several hundred bonds. They have to list every bond that they purchased, every bond that they sold, every stock that they own, every single asset they own is listed. And that's probably 1,000 of the 2,000 pages is just that. It's just extremely lengthy insight. So we don't have time, but you have the class notes. You can look at it, GAAP versus stat. What's the difference in those two? So I do want to spend a little bit of time, maybe Thursday we'll do this, a little bit of time on life insurance regulation and then work some problems. Do you have any idea yet which problems you're most worried about? Or you want to just work some of all? How do you feel on joint life? Is that like you got it now? What about the modified endowment? You got that one? So what don't you know? The more complicated problems? So maybe I'll do a few more examples of that. We'll see. If we have a little more time, I'll give you some of the key stuff on here. And I may give you a quick on investments because it's kind of important on life insurance side. All right, we'll stop it there. All right. So last class, we've covered the endowment. You have those other problems there in the notes. You're getting somewhat of a sense of all the formulas look very similar. You got a bunch of D's in the numerator, a bunch of L's in the denominator, maybe an extra L in the numerator. We talked a lot about how you get the ends. So if you can do the endowment, you should be able to handle the other products. The more complex problem, I think you're getting a little more comfortable with that they're not nearly as hard as they look. It really comes down to getting the numerator and the denominator, and especially getting the ends in the right places. The joint life, we've done a couple of those, so I think you're getting more comfortable with that. So I want to work one more ALM problem, just because it's been a while. So I'm going to do this last one. So all I'm going to give you is triple B and high yield. First, it makes the exam a little easier to manage, not as many calculations, but plus life insurance companies don't buy treasuries. They don't buy AAAs. So there's no reason to put them on the exam. You have somewhat of a sense of what's going to come out. I wrote this when interest rates were really, really low. So this exam for us, I can use a little bit more realistic numbers because interest rates have come up quite a bit. So we can now have 6 and 7% type of yields. It's hard to believe high yield bonds were yielding 6.7% or even lower. It's pretty amazing back in 2021 how low yields got. So it'd be a little bit more realistic problem. I'm about to sneeze. All right, thanks. All right. So won't be quite so crazy, but if the yields are that low, it also means our crediting rate's going to be really low. So that's what they have to do. When they offer a new product, they're going to offer whatever current rates are, but once they offer it, they're kind of stuck with this. So this is one of their most dangerous products. They're offering a credit rate of 1.3%. If rates rise, they can't really change that because they bought this bond at 3%. It's a 5-10-year bond. So you can see how dangerous a year like 2021 is for this industry. If they sold a lot of product then, and they're probably pretty competitive, right? Because the bank CDs are like 0%, they were competitive, but they didn't want to be competitive because now they're stuck with these products. So this problem, as realistic as I made it, is somewhat of a scary problem. There's probably a good chance they weren't selling too many of them because who's getting excited about locking in a 1.3% yield on a product like this that's pretty illiquid. So if you look, the steps I gave you up here, I'll try to follow the same steps. So you start with your capital charge. So you're going to have the triple B, you're going to have the high yield, and you're going to have C1 asset risk and C2 interest rate. I'm sorry, C3 interest rate risk. C2 is mortality risk. We're not really concerned about that. And then we have the total. So here, the capital charge, you need two things. The capital charge is 4%. But their target is 150%. So you can multiply that by 1.5. And the premium, I'll probably keep the premium the same as $100,000. So if someone walks in with $100,000, you're going to need to set aside 6,000 of that for the chance that this bond might default. Okay, remember, the C1 risk is not the average default, it's the default in an extreme year where you have major catastrophe, major bankruptcies. C3 risk is given right here. It's 1%. Don't forget to take the 1% times the 1.5 times 100,000. All right, everybody see where I got the 1.5? Target EBC ratio is 150%. C3 risk, 1%. So their total capital charge is 7,500. What's the only thing I can change in here? But the only thing I can change is the 150% ratio. It might be 160, it might be 140, but the 4% and the 1% are going to be the same because that's what the charge is. So I'm not going to change it from what the law says. High yield, their capital charge is 20%. So 0.2 times 1.5 times 100. That's going to be $30,000. The C3 is going to be the same. It doesn't matter because it has nothing to do with the assets. So theirs is going to be 31,500. So any questions on that? I would start with that because you can't finish the table until you have those numbers. You might as well get them out of the way. Step 2 is build the table. So I'm going to insert a table here. And we need 3 rows. 1, 2, 3, 4, 5, 7. We'll try 7. I probably don't need 7. We'll try that. So here's the asset. Anybody remember the columns? What's the first thing on the income statement? Yeah, investment earnings, your revenue. What's the second one? Yeah, so it's net revenues. So you're going to take a little bit off of your revenues to set aside some for the average default. Remember, the $6,000 is for the worst case default. Here is for the average annual, so we don't give that to the customer. Then what's next? Cost of goods sold. What's our cost of goods sold? It's your claims or benefits, right? Your crediting. Then you have just your expenses. Oh, I did get the right number. Then you have your net income. And then you're going to calculate the ROE. So those are the columns. So we have triple B bonds, we have high yield bonds. So the investment earnings is pretty straightforward, 3% and 6.7. So 3% times 100 equals 3,000. 6.7 times 100, 6,700. Our haircut, they give that right here. 0.1 and 2%. There's no adjustment. The only place you're making that adjustment is for the risk-based capital. So no adjustment. So make sure you convert 0.1% into 0.001 times 100. And I think that's $100. And here for the high yield, it's 2%. That's 2,000. And then crediting, that's going to be the same no matter what product you have. You're not going to change how much you pay your customers because you're trying to find the best investments to meet that competitive amount. So 1.3%, your 1.3 times 100 equals 1,300. So 1,300. Same thing on expenses. It's the same. Your expense load is 1.1%. And that's going to be the same no matter which one you're doing. So here you just have to do the math, which y'all know I can't do in my head. So I'm going to guess, let's see, 1,200, 2,500. That looks like 500. What is that? 500. And then here, 2,300. 67, 47, 37, 34, 24, 23. That looks right. And then your return on equity, 500 divided by 7,500. 6.7.
6.6.
Here, 2,300 divided by 31,500. I know that one. 3%. All right, hopefully those are the right numbers. Their target ROE is 7%. So only high yield meets 7% target ROE, but we cannot put 100% high yield. Likely we'll allocate up to what? I'm giving you 10%. I'm not saying that's an industry standard. I just know, to me, it's really easy to remember. They have $10 in net worth for every $100 of assets. So once you put 10% in high yield, you essentially have 100% of your net worth in high yield. That's the way the rate agencies think about it. It's very rare for a firm to want to have more than 100% of their net worth backed by high yield. So they're most likely going to miss the ROE, but we'll talk about the 7 things. I won't type them all out again. It's not the math's not difficult in this problem. You just got to know where to pull the numbers, but it's a simple problem if you memorize the pieces of the table. And then while you're doing, think about what you're doing, because there's a lot of intelligence of the industry in this process, what they have to do. And then this last part of the question, fully discuss what can they do if they're not meeting that 7%. And that's this list here. So you want to give the item and then talk about the ramifications of that. So can they increase that 3% sum? Get more yield? Well, you tell a bond person to get more yield, you're telling them to take more risk, generally. There's not like a lot of great bonds sitting around with great yields that no one's know about. They're out there, people are looking for them, they're fighting over them. So that usually means taking more risk. How do you take more risk? Well, if you took my investment class, it's a DC cuts I, you can take more duration, you can take more convexity, you can take more credit. Usually it's credit risk is what they're talking about. But yeah, 2 bonds may be BBB rated. One may have a higher yield, but it has a higher yield, not because the bond market's stupid. It has a higher yield because it's riskier and the bond market knows it. Just because they're both BBB doesn't mean they're exact same risk. You can have 2 BBBs and one slightly riskier, but they both fit in that big category BBB. So yeah, maybe you pick up another 10 basis points, but it's because the bond market thinks there's risk there. You can hold less of a haircut. That to me is either the number's right or it's wrong. If it's right, then you need to hold that. If it's not right, then yeah, adjust it to the right number. So the only way you can really cut that sum is if you were just being conservative and coming up with a number and maybe pull back on some of that conservatism. But you're not fooling yourself. And you could do this with your home insurance, right? You just buy less home insurance. Say, well, I'll insure 200,000. Well, if your house is worth 400,000, you're not doing yourself any favors. So you got to be honest about these numbers. So reduce crediting rate, that one's pretty obvious. If you do that, you're going to be less competitive. That's real obvious. Reduce expenses, well, duh, you should be doing that all the time anyway. Anytime you move more efficient, every firm should be doing that if it's a competitive industry. You can reduce that 7% standard, but then your stockholders are going to be upset. They're eventually going to make you pay for that in a lower stock price. So that's not going to be good. You can reduce your RBC target instead of that 150%. But if you do that, you could lose your credit rating and you're going to be viewed as more risky, which means you're going to need a higher ROE anyway. So that's not going to work. Or you can somehow try to get that C3 risk down by making the product safer. But if you do that, it's become less competitive. If you put higher surrender fees or whatever, you're not going to be as competitive. At 1.3 is not going to be as competitive if you have more protections. I don't know how sensitive customers are to those type of protections, but they probably have some awareness. So you have 7. How many should you put on the exam? I'd put 7. If you put 8, that'd be really interesting to me. So I'd be really curious. But if you put 5, you're going to lose some points. All right. So put 7 down there. Has anyone come up with a good mnemonic yet? We were talking about the CFA exam earlier. I had a 60-something letter mnemonic for the CFA exam. And I had it memorized for parts 2 and 3, and I never asked the question. So irritating. but this is not a 64-letter mnemonic, so it's definitely. But the other part of it is it somewhat follows the income statement. Get more investment earnings, reduce your haircut, reduce how much the crediting is, reduce your expenses, reduce your ROE target, reduce your 150, so you can kind of, the 7 of them are there. They're all on the page. So you can get the first 4 just by going across the top of the income statement. They're right there. All right, y'all feel good on that one? It's kind of a gimme question, I think. So, right. Any questions y'all have on the exam? I want to cover a few things that you need for interviews, but exams Tuesday in here at 5 o'clock. Try to be on time, because I mean, you have more time than you will need, especially because your first question, you're gonna submit this. I gave you a little extra time on this. I forget what I think I said noon on Wednesdays. So you have an extra day on that problem. So you really shouldn't need much more than an hour for the exam, but still get here on time, just in case. So I probably won't. I'm not going to give you annual renewal term. I'm going to give you a level term. Ordinary, remember ordinary life? It's 97. You do D97, D98, D99, L97, L97, L98, L99. If it says ordinary life, your D's and your L's are exactly the same. All right. Endowment, you're going to have that one. We've already worked a few of those. You got to do that full-blown problem. And then the crazy problem. Don't forget on the crazy problem that I give a lot of partial credit. So put down the obvious stuff. Don't just freak out and leave it off. I have some students, that's the first problem they do. They're like, I want it on a fresh mind. So yeah, maybe that's a good strategy. I don't know. We did the joint life last class. So you have that as a video, plus you have it in the class from last time. We worked, I think, 2 problems last time. So I think y'all were getting pretty comfortable with that one. And we just did the deferred annuity one. So that is the exam. So there's no other trick questions or anything. You notice I took off the symbols because that was always an irritant. I think the average on the symbols was like 40% in previous classes. So I deleted that for you, so you don't have to worry about that. So that should make the exam much easier. Any questions? You can obviously call or email me if you have a specific question. Remember, I like depth on essay questions. And remember, don't give me my words. So these will be in your words and these have some good depth to it. All right. So a few remaining things. I brought up MetLife's annual report. And this one page I really like. It's called the 5-year historical data. For them, it's on page whatever. I don't see a page number. Oh, there it is on page 113. It's hard to find. I did a search on 5-year and it still didn't find it. So, but what I like about the 5-year is you get a lot of data over time. So things like what kind of products do they sell? You can look at them. They do a lot of group. They do some industrial life. We talked about industrial life. That's a really shrinking product. I don't know what SG single group life. I'm not sure what that means, but they do a lot of groups. So this is MetLife, a lot of group policies, a lot more than individual products. So that seems to be their main business line. Now, if we looked at Northwestern, what Northwestern has all the salespeople with commission salespeople. That's a lot of individual products. You'd probably notice that more there. It's a very different business to do group than it is to do individual products, because group you're selling out to corporations, to HR people, that kind of thing. They have new business. What do they sell this year? So that can be interesting. their premiums. Where do their premiums come from? They show the balance sheet. Their total assets, you can see $254 billion. This is just MetLife's life insurance company. If you look at MetLife, the corporation, it's much bigger than this. So in life insurance, they don't consolidate, it's individual companies. They have health reserves, deposit-like contracts. What deposit-like contracts means, these are these deferred annuities. And also a lot of deposit-like products are when people have life insurance claims, they leave it with the life insurance company, and it's just like a bank CD or a bank checking account. So you get some good information. The one I really like is the risk-based capital. They show their total adjusted capital. So this is essentially their net worth, and they have their authorized control level. What authorized control level is, it's 50% of risk-based capital. And so what you do, let's see if I can get this into Excel. I put this on the exam for the property and casualty side, but I don't put it on the exam for y'all. Yeah, it's not going to let me do it. So 15,665, 16,853, 15,129, 14,561, 14,093. 2283, 2312, 2131, 2038, 1984. So this is what they call their adjusted capital, which is their adjusted net worth. It's going to be really, really close to their net worth. A few minor adjustments are very, very close. I'm scared to go back to it, but we go up to their assets and liabilities. Yeah, it's a little tough because they have separate account business. Yeah, that's a much bigger difference. They have the separate accounts, so it makes it a little trickier. So I can't really, but it's essentially their net worth, but with some separate account adjustments. This is 50% of their risk-based capital. So you need to take this. So how do you get risk-based capital? You multiply that by 2. So that's their C1, C2, and C3 risk. The way the law is written is that the first part of the law gets you risk-based capital. Then the second part says take that times 50%. And then the third time says take this number times 2. And that's what you use. So it's really convoluted. We wrote 2 letters to the regulators saying just eliminate this number. You don't need it. Just use this number, but we lost on that. Their thought was, we want to hide this as much from the public as possible so people don't know this number, but that didn't work. But anyway, what they give in your annual report is 50% of the number you need. So essentially what they're saying is this is what you have. This is what you need. And so your RBC ratio, you just take the adjusted capital, divide it by that. And you usually state it as percent. So they have 3.5 times what they need versus the regulator. Now you don't want to have 100 times one because you have 1. If you fall $1 below, you have to go to court. You're taken over. The regulators can take over your business. So you need some cushion. You saw on the exam question, I used 150%. You can see they're much, much higher than that 150%. At USAA, we're generally 400, 500%. I saw we had one company, it was like 10,000%. So they can be fairly high numbers depending on the business. Does a firm with a 343, are they safer, more highly rated than a firm with a 200? I did that analysis and it didn't really show a strong relationship, but you would probably prefer to have a firm with a 343 over a firm with 200 if you were buying a product from this company. So how does this stack up with everybody else? The problem is I can't get this data from like Bloomberg or anywhere. We talked about the SNL database. So if your firm has the SNL database, you could certainly pull the risk-based capital ratios for every life insurance company out there. That's what I did at USA. I compared USA's life insurance company to all of its competitors to see where they ranked on risk-based capital. So you could certainly do that. It is a fairly sophisticated formula. It does capture things. It's weaker on the property and casualty side. On the life side, it's actually pretty strong. The way this worked, and it's probably the way the industry works, the life actuaries did all the work, came up with the ratio. They wrote this massive paper, and then the P&C actuaries just copied it. So, that's kind of the way it works. Why? Because the life side had far much more they could work with. The P&C side is much more difficult. So the life side, really impressive paper. So it is a very sophisticated formula, very, very economic. So you would hope there be some relationship between this number and the safety of the company. I would rely more on credit ratings though than I would on this number, because that's even more sophisticated, but it is a decent number. But you get that off of the 5-year. In fact, that's about the only place. That's the only place you can get it in this report is on the 5-year. They do show the assets. If you look at the assets, you notice over 50% are in bonds. They show that they have stocks, but it's possible they have no stocks. And the reason for that is a lot of their stocks are affiliated stocks, so it's subsidiaries. So I would guess they probably have zero. Most life insurance companies have zero in stocks. Property and casualty companies might have 5, 10, 15% in stocks, but life insurance companies generally do not buy any stocks at all. So just because you see some stocks here, that really probably is still zero because of affiliates. So you see what they have is bonds and mortgages. That's what a life insurance company buys. Why? Because they're interest rate sensitive. They earn an interest rate and they pay an interest rate. It's a spread business, just like a bank. Real estate, probably most of this real estate is their home office. So they get real estate 2 ways. They have their home office. For USAA, that's a big asset for them, is their home office. The other way they get real estate is from line 34. How do you get real estate from a mortgage loan? When someone defaults on their loan. It's not a good way to get real estate. So most of their real estate is either going to be the home office or it's going to be loans that defaulted. Cash equivalents, contract loans. This is really interesting. They show that as an investment. The contract loans, that's people borrowing their money against their cash value. They show that as an investment. I normally kick that out as an investment. I don't consider that to be an investment. They have derivatives. These are probably swaps more than anything else, interest rate swaps. They have a pretty hefty other invested assets. No telling what that is. You can find it in here and see what that is. Life insurance companies don't buy a lot of private equity. They don't do a lot of hedge funds. So I'm not really sure what that is. 8.9 is a really huge number. This is percent. That's a really huge number for them. Some firms do a lot of securities lending, but doesn't what MetLife does, at least not this company. So when you're looking at a life insurance company, it's going to be almost all bonds and mortgages. When you look at a P&C company, you're going to start seeing a lot more in stocks. You're not going to see much real estate. There's only one property and casualty company with a huge real estate portfolio, and that's USAA, and even they're kind of arm's length on that. So real estate's not a popular asset. So you get a good sense of what they're doing. The nice thing about the annual report is you can go into this 57.8% and see how much of it is high yield, which is an important number as well. It's not in this page, but you can find it on another page. So you can see how this 5-year is really quite useful information. Here you can find the affiliates. So most of their stocks is affiliated stocks. You can get their investment income and do it as percentage of their invested assets to see kind of what investment return they have. You can see big years. Why did they have such a realized loss last year? Because interest rates shoot up and bond prices fall. So they had a huge capital loss last year. They have some ratios. This ratio right here is really, really important for life insurance. It's their lapse ratio. That's how many people cancel their policy. Huge. You actuaries are going to have to deal with this. You work at a life insurance company. That's one of the major assumptions they make about a life insurance product. How many are going to make it to the end? We're not talking about people who die. That's not a lapse. You don't lapse when you die. That's a claim. A lapse is you have a 10-year level policy, but you cancel it after 4 years. That's very, very important. Why is that important? Well, life insurance is real expensive in year one because you have to do underwriting, you do blood tests and medical exams. The worst thing you can have is someone buys a life insurance policy, you spend all that money, and then they cancel the policy 2 years later. USAA has one of the lowest lapse rates in the industry. Their numbers are like 1%. And that allowed them to be much more competitive because they could spread those year one costs over more years. So this might be an interesting number if you're looking at a company to compare this with a few companies and just see, like if you're interviewing with USAA, well, I don't know where you find their statements, but you say, well, I heard USA Life that your lapse rates are some of the lowest in the industry. If you can compliment your company in the interview, that's always a good thing. Don't you want to work for a company that has low lapse rates? That means they have good products, they have good service. That's a good indication of a good company, but it also can mean they're going to be more competitive. Here's their A&H loss. Now, what did the Affordable Care Act say? You remember? That number needed to be what? Some of y'all wrote about it in your paper. You got your 25%. How did you get that? You remember? This number needs to be 80. Y'all remember the 80% loss ratio? So are they hitting 80%? Doesn't look like it. But this is statutory, the 80%, who knows what that's based on. And again, looking at their net income from the different products. So you can tell a lot. So if you interviewed with MetLife, the bulk of their products is group annuity. That's the bulk of their earnings. They made $2.4 billion. 50% of that was group annuities. So what are group annuities? A lot of those are for pension plans or for 401k plans. A lot of 401k plans have what they call a guaranteed income or guaranteed interest rate plan that they get from life insurance side. Now, what do you notice about that product that really stands out to you? Does that look interesting? That's a pretty big change, isn't it? Going from 2.7 billion to 1.2 billion. You might say, what happened there? 2022 was not a good year for them. So yeah, that's what happened. Interest rates shoot up like that. So a lot of information. There's other schedules in here that are very interesting. So if you're interviewing with the company, it's very interesting. The problem is there's a lot of pages in here that aren't interesting, like pages and pages of footnotes and footnotes and footnotes and footnotes. I have never read all of these footnotes. Now remember, in the 70s, they didn't have computers. So somebody was typing all of this every year. Have y'all seen the TV shows where you have 50 people in a room on typewriters, right? Your typing cord, that's what they're doing. Now it's all computers, and you probably just copy and paste from last year and update the numbers, and probably the computer updates the number. When I started, I may have told you all this, but when I started at USAA, they had the Schedule D on computers, which is the bulk of this. Schedule D is all the investments. We had just gotten that link, so we didn't have to type all those investments. So, but look at all these footnotes. It just goes on and on and on. Forever and ever and ever. And then the other thing you have are the investments, and that's all this last part. It's just probably hundreds of pages listing every single investment that they own. And it just goes on. So there's a lot of detail in here. There's just too much detail. But if you go to the first page of Schedule D, which is way too many Schedule Ds. There's a summary page that I like. And my computer is now frozen. There's a summary page, and after the summary page, there's a really good schedule on bonds. And if you find that page, that's where the breakout is between investment grade and below investment grade. So if I were interviewing a firm, I want to know how much they do in below investment grades. So it's Schedule D, so you have to find the Schedule Ds. The Schedule B Schedule BA especially shows you those other investments, so you might find those there. But you see right here, total bonds current year. 1 through 4 are investment grade. 5 and 6 are below investment grade. So here's the total. So right here, you can see they don't have much in high yield down here. I think I'm 4 might be high yield as well. I cannot remember. I have to go. Boy, it's been a while since I've looked at this. I know 1, 2, and 3 are investment grade. 4 might be below investment grade. I'm not sure. If it is, they've got 2.5 billion out of 100. So, 10% would be 14, 15 billion. They don't have 15 billion. So probably 4 is high yield. Now I know it doesn't say high yield. NAIC is a regulators, but their rating criteria follows the investment rating agencies very, very, very closely. So this is a very useful schedule to see. So I gave you that 10%. If you're interviewing with the firm and those bottom 3 lines are more than 10% of this, you could bring that up in an interview and say, wow, you guys buy a lot of high yield. They'd be pretty impressed that you would know that. They may be a little nervous while you're asking that question. At USA, that number was practically 0 because our CEO hated high yield. So it was just a challenge. It kind of offset their advantage on the lapse rates. So a lot of good information here. You can't get any of this out of GAAP financials. The SEC filings do not have this level of detail. So you have to find this. MetLife has it. Allstate provides this. I don't think State Farm does. They're not publicly traded. But if I were interviewing with a life insurance company, you can just Google it, Northwestern Mutual Statutory Financials, and just see if anything comes up. They have an annual report, but that's probably not it. Like USA has an annual report, but there's nothing in it. It's just so high level. It includes P&C, life. So since Northwestern Mutual is a mutual, it's not publicly traded, they won't have it. But so far, every time I've looked at a publicly traded life insurance company, they've had it. So like Prudential, it might be in there. So you'd have to go under investor relations and find it. So I don't know what insurance companies you life insurers or life insurance actuaries are interviewing with. Now, if you're interviewing with USA, it's a little tough to get this kind of information, but looking at some competitors, you could certainly, and it'd be impressive in an interview, especially in finance, to say, yeah, I was looking at the statutory statements for MetLife and I noticed they had this. I'm curious what USA does there. That would be a very impressive thing to say, the fact that you're looking at statutory. Most undergraduate students don't know statutory financial statements exist. And that's where most of the information is. So it would be impressive, but I don't know if they have that kind of information. I don't see investor relations yet. There it is. It might be out there. You have to search around for it. All right, so great information. If you're analyzing life insurance companies, so if you're trying to figure out the kind of company you want to work for, I would want one with a decent rating, at least single A rated, because I think life insurance, most of their products are promises for 10, 20, 30 years. I want to work for a firm that's going to be in business in 10, 20 years. So single A rated. Most life insurance companies are rated, even the non-public ones, because several years ago, Standard & Poor's said, you can pay us $40,000 for a rating, or we'll rate you without your request. Your choice. Do you want to come and do your dog and pony show and we give you a rating, or we'll rate you based on the data we have? And guess what? They got a lot of money. A lot of firms says, well, we'd rather have some control over this process. And so that got them a lot of ratings. USA was already being rated by them. The interesting thing about life insurance companies is they rate the debt, but they also rate the company. And that's pretty unique. You're not going to see that. They don't rate IBM. They don't rate other companies. But for life insurance companies, they have what they call a claims paying ability rating. So we're essentially giving a rating to the policyholders. That's the rating you want. That's what you're interested in. Like at USA, yeah, they have a debt rating, but you really want for the life insurance companies, what's their S&P Standard & Poor's claims paying ability rating? I don't know if you can Google it and find it. When I left USA, they were AAA at the P&C property and casualty side and AA at the life insurance side. I'm sure the P&C has dropped at least the double and maybe down to single. USA has serious problems right now because the rating agencies hate banks. And USA's bank, that's why I'm kind of surprised they haven't sold their bank yet. Because that bank is an Achilles heel. It really hurts the rest of the institution just because of the way the rating agencies look at it. So that, because of that subsidiary, that's a very fast growing bank, is probably pushed. You may know what USA's P&C's rating is. Is it single A yet? Maybe they're still double A. I don't know, but you as a policyholder, that's your rating. And so even if a life insurance company doesn't have any debt, they'll have this rating more than likely. What they do is they do typical fundamental analysis, just like you would do. They look at return on equity, look at growth, they look at loss ratios, they look at all kinds of things. They meet with the company once a year. At USA, this was a massive event. And we got our CEO in there to present, our CFO to present. I had to present a few times on our investment side. It's a major, major undertaking, usually 2 or 3 days of presentations. Then the committee makes a review and they publish a rating, but they say that the ratings are always current, not just after a meeting, but all year long they're current. And so that's the process. If you wanted to get a job like this, it looks great on the resume. It's a horrible job, but it looks great on the resume. It's very, well, I probably told y'all some of these stories, but a good friend of mine went to Standard & Poor's to rate life insurance companies. I visited her once in her office, but she was telling me when she showed up, there was just paper everywhere in stacks, like 4 feet tall stacks. So whoever she replaced, he just left with a mess. And she walked into that mess. And she knew life insurance very, very well because the 2 of us had worked. We did a lot of work on our insurance companies. But she comes in and says, what do I do? And they say, I don't know, do whatever you're supposed to do. They gave her 0 training. So it's a very high stress job. So you'll have to know this industry before you start working for it. You're not just going to walk. There's no training. And so she did her analysis and she says, I'm ready to publish my first report. And they go, okay, so publish it. So, well, does anyone review it, look over it? No, just publish it. So it was very bizarre. She was very, very smart, very confident. She had no trouble with it. But I don't think I could have done that. I would have been like, I want someone to look, at least the first time, look over my shoulders and make sure I know what I'm doing. Now, obviously, she knows what the person before her did. So if he rated the firm single A, she's probably not going to make it double B, more than likely. She's probably going to keep it. But she's going to be responsible for setting up the meetings, doing the analysis, leading the committee, and then publishing. She may not decide the rating. The committee is going to decide the rating, but she has the right to report to justify that rating. So what is she going to write about? Well, it's going to be quantitative and qualitative. They have a view on their overall industry. Obviously, right now, they're worried about property and casualty with earthquakes and hurricanes. They're probably worried about life insurance companies with interest rates rising. Their main focus is going to be on net worth. They're going to have their own risk-based capital formulas. They're going to assess the firm. I think I've told some of you, Moody's developed their first risk-based capital formula, and they called me to run it for the industry. And I was like, yeah, bring it on. I was the first person to get to see it. I essentially worked for them for free. My boss was like, yeah, that sounds good. So I got to see the ratio for anybody else. I ran it for the entire industry, sent them back to database. So that was pretty cool. Their risk-based capital formula look very similar to the one you're seeing on the exam, C1, C2, C3 risk. So they run those ratios, and it's very similar. How much net worth do you have versus how much you need? They will do a run on the bank scenario, just like we saw with Silicon Valley. With life insurance companies, what's the probability a bunch of their annuity holders are going to cancel their policy and go buy a CD? So that's that disintermediation risk. They look at asset liability models. There's something called the New York 7. I don't know, actuaries, have y'all heard that before? The New York 7? Does that sound familiar? So the New York 7, it's 7 interest rate scenarios that you have to run your business through. It might be one where interest rates fall and then rise, might be one where they rise and stay up, those type of scenarios. I'd love to see those scenarios for life insurance companies right now. It'd be really, really interesting. They're quite strenuous scenarios. It takes the actuaries hours and hours and hours to run them, although probably today they probably have them set up pretty well in their Excel models to run pretty quickly. A lot of life insurance companies do like 1,000 simulations of different interest rates environments to look at. So essentially what you're looking at is that short strata we're talking about. When does this product blow up? When is it unprofitable? And that's when those lapse rates become extremely important. If you're paying 5 and banks are paying 8, what percentage of your customers are going to leave you? You have to get those assumptions in there. They're very sensitive on asset quality. They don't like, rating agencies do not like junk bonds. They don't like concentration. They don't like having a lot of exposure to one company. They want to know what your market share is. Is it growing? Is it shrinking? This was a huge issue for USAA when they opened up their market to the enlisted market. That was a huge growth for USAA. And so now they're like, are you sure you price your life policies correctly? Are these people really healthier than average? Are they going to die faster? Do you know what you're doing, right? They're really scared. They like you picking up market share, but not really fast, because if you're picking up market share really fast, it could mean you're mispricing your policies. You're taking on too much risk. That was true on the P&C side, but not on the life side. The life side picked up a lot of new products and they were really, really good. The auto side picked up a lot of new customers and they were horrible drivers. So their agencies are worried about that. Any major shift. We talk about lapse rates. That's extremely important to them. They're worried about subsidiaries. What are your subsidiaries doing? Could they blow up on you? They want to hear from management. So we had an issue with our CEO. He was so mad at Moody's and what they said, and they were like cooling him down in the hallway. Said, please don't blow up. He wanted to just tackle them. Like, you guys are idiots. You know what you're talking about. Like, no, can you just be a little nicer? But they want to hear from management, hear what they're saying. Obviously, they want to hear from the actuaries, from the CFO, from the investment people. They want to say, do you guys know what you're doing? Do you understand this business, understand the risk? They want to hear from the underwriters. How do you assess risk? How do you decide whom you're going to sell a product to? And then growth. Is the business growing too fast? Is it shrinking too fast? So if I were interviewing with the insurance company, I would have this list with me. This is, you know, you might tell them, hey, I want to work with a really high quality company. You may say, well, what's a high quality company? Obviously, you have competitive products that are appropriately priced. You're not competitive because you're charging too little. You're competitive. You have very good expense management. You have very good investment management. And you know how to manage risk. Those are kind of things they want to hear. You have low lapse rates. That's what you could say at USAA. You don't want a lot of customer turnover. That's very expensive. So this is a good list. How did I come up with this list? I read many S&P and Moody's write-ups, and I just pulled from that list of the things they were writing about. So it's a little dated. I haven't read one in a while, but I doubt it's changed that dramatically. Right. Are any of you interviewing with life insurance companies? I don't have a single life actuary as an alum. So we need one of y'all to get on the life side. Give me a contact over there. I know a lot of life actuaries that are all retired. I don't know any life actuaries that are still working. So I'm losing my contacts. All right, regulation real quickly. The key with regulation is, what are they worried about? So They're worried about solvency. That's where that risk-based capital comes in. They're worried about market conduct. Are you ripping off your customers? Are you treating them correctly? They're worried about that. Churning and twisting. Churning is what you saw with Danya, right? You're selling her a new product that she doesn't need, so you can get that commission. Twisting is when you oversell it, and you're kind of pushing the tax advantages when you don't tell them about the tax disadvantages. Pricing, they're worried about pricing. On the life insurance side, they're mainly worried that you're pricing enough, that you're not underpricing. They tend not to worry for overpricing. Regulators tend not to care if you're charging 500 when you should charge 400. On the property casualty side, they're worried about overcharging. On the life side, they're worried about undercharging. So primary focus on life side is adequacy. Are you charging enough? The property casualty side is really worried about not charging too much. The P&C side is also worried about discrimination. Life insurance side doesn't really worry about discrimination because it's pretty obvious they're going to price on gender, smoking, non-smoking, avocation, things like race or religion, those kind of things. They don't even look at that kind of stuff. They're going to look at family history on those things that we're pretty comfortable with. So if your family has a family history of heart disease, yeah, most people are comfortable with that. So that's what they're worried about. So one last thing you need to know when you look at life insurance companies is a little bit of the history of regulation. So regulation in the United States, there was none when the US started as a country. And insurance companies were just selling insurance. Insurance wasn't that big of a deal back then, but there was some life insurance back then. And if you think about the US Constitution, if you sell a product across state lines, that becomes a federal government issue. The state of Texas can't regulate how someone in Virginia sells refrigerators in Texas. The federal government, I mean, Texas can, but the federal government's the primary one. And so that's called interstate commerce. So when you have interstate commerce, the US Constitution says that's the federal government. I like to read the federal, what is it? The Federalist Papers, like once a decade, because they're really boring, but they're very interesting in spots. And Madison has this impassioned plea that the federal government needs to do three things. And this is one of the three things he argues for. The federal government should restrict or should regulate when the citizen in one state is doing business with the citizen in another state. If you don't do that, each state is going to protect their own citizen. And you're going to have these big battles. Now, if you're in Texas and you're doing business with people in Texas, the state of Texas, they're in control of that. So the Supreme Court got a very, very famous case. It's called Paul v. Virginia, where Paul lived in New York and he wanted to sell insurance in Virginia. And this case came up to the Supreme Court, and the Supreme Court asked the question, is insurance commerce? Because if insurance is commerce, the state can't regulate that. The federal government regulates it. I think insurance is commerce. It's pretty obvious it's commerce. If banking is commerce, insurance is commerce. But 1869 is right after the Civil War. There's a lot of states' right issues. The Supreme Court was a very pro-state Supreme Court, and they decided insurance is not commerce, states should regulate it. And because of that, the insurance industry goes, and I don't know how many states we had in 1869. Maybe it was 35. I have no idea. But let's say there's 30 states. An insurance company that deals in all 30 states, they just said, great, we just went from one regulator to 30 regulators. That's not fair. And so the states got together and they created, y'all remember when I was showing you the credit ratings, it was NAIC 1, 2, 3. That's the National Association of Insurance Commissioners. All the regulators in all the states got together and they said, let's streamline this. Wherever we can all do the same thing, let's all do the same thing. So if you're interviewing with an insurance company, you need to know about the NAIC. I would probably go to their website and look at stuff that's going on. They do the accounting. I just showed you MetLife's statutory accounting that comes from the NAIC. They have model laws like the risk-based capital model law. They have investment laws. They have laws related to market conduct and treating customers. So there is some overlap between states. Some states are more difficult, like New York. Every life insurance company that does business in multiple states will have a separate entity just for New York, because New York is the most onerous state to deal with on the life insurance side. Like USAA, when I started, USAA just started a company called Life of New York, just for the New York business. All right, so that was the lay of the land. The federal government does not regulate insurance, like life insurance or property and casualty insurance. But then in 1944, another case came before them, Southeast Underwriters Association. This was an association of property and casualty companies, and they were sharing information for pricing. And the United States government said, wait, that's collusion. That's antitrust. You can't do that. So this case went, and Southeast Underwriters said, you can't regulate as federal government. We're regulated by the states. That doesn't mean the states can't regulate antitrust. They could, but the federal government was going to say, no, that's antitrust. You can't do that. Southeast Underwriters said, no, we've already decided insurance is not commerce. This goes before the Supreme Court, but this time it wasn't versus Virginia. It was versus the federal government. And the Supreme Court reversed Paul versus Virginia, and they said insurance is commerce. Now insurance companies go, well, now we had 50 regulators. Now we have 0 regulators because the federal government has nothing in place to regulate insurance. So we went from 50 to 0. That sounds pretty good. And the federal government, for the first time in their history, they got together and moved fast. And they wrote this law. You need to know McCarran-Ferguson if you're going to interview with an insurance company. The McCarran-Ferguson Act in 1945, what they said is, okay, Supreme Court, we're responsible for regulating insurance. Nothing in the Constitution says we can't sublet that out to somebody else. So we're going to hire the states to do this for us. And that's the McCarran-Ferguson. So essentially nothing changed. Kept the states as the regulator. There have been challenges to that. USAA was fighting for like a separate federal charter so you could choose federal government or states. I don't think USA got very far on that because no one in the industry was with them on that. They're all by themselves. I was at the gym back when I used to go to the gym, sitting on the bike, and President Obama was talking about McCarran-Ferguson. Guess why he was talking about that? He said McCarran-Ferguson is why health insurance is so horrible because they're not regulated by the federal government. He wanted to overturn McCarran-Ferguson so the federal government could regulate health insurance companies. And that was his argument. There's no antitrust. That's not actually quite true because states do regulate antitrust, but he just didn't think it was rigorous enough. So even President Obama was he actually said the words McCarran-Ferguson. So that's how important this law is. So it was an important law. As of today, McCarran-Ferguson is still in place except for one exception. And we talked about it. It's those variable products. The variable products are regulated as an investment at the federal government. But otherwise, everything else is regulated by the states. So keep that in mind. That's pretty important. So that's a pretty good, if you know this, you're in good shape for interviews. So you might look up Paul v. Virginia, McCarran-Ferguson, Southeast Underwriters. You know those 3 things, you've got the industry layout pretty well. Okay, that was a fast, boy, I gave you a lot of stuff at the end. Sorry, I spent so much time on health insurance. You can read the rest of the notes. The legal side, I do cover that in my P&C side. So if you take that class, we'll catch that there. So, all right, that's it. Any final questions?